In the world of trading, there are two distinct aspects, the psychological and the technical. Today, our focus won't delve into the psychological realm, but rather, we'll concentrate on the technical side. Within this technical realm, two crucial elements demand our undivided attention: price action and volume. I believe that we should place significant emphasis on understanding and analyzing price action and volume as much as possible. A common observation I've made among traders, particularly those just starting, is a tendency to fixate on indicators. There's often a quest for some mystical element in the market that can signal the perfect time to buy or sell. However, I want to emphasize right from the start that such magical indicators do not exist. There's no secret formula or magic bullet. What does exist, however, is the ability to comprehend which force is prevailing. Is it the buyers or the sellers? Identifying the more assertive party is crucial, and to begin grasping this concept, I advocate focusing on the fundamentals of price action and volume. If your trading chart is cluttered with numerous lines and indicators, my advice is to clear the clutter. Reflecting on my journey in trading over the past decade, I recall a time when my chart was inundated with indicators and lines. Unfortunately, this led to confusion, making it challenging to identify optimal entry and exit points or to effectively manage my positions. Over time, I realized that all the additional elements on my chart were merely noise. The fundamental aspects that everything boils down to are price action and volume. I reiterate these points to emphasize their paramount importance in trading. Now let's dissect what volume signifies. Volume essentially represents the transactions occurring in the marketplace. For instance, if you observe a volume of 1, it indicates a single transaction. A sale has taken place. It's crucial to correct a common misconception about volume. It doesn't indicate more buyers or sellers. Instead, it reveals the presence of more aggressive buyers or sellers. For instance, a volume of 10 signifies that 10 contracts or shares were transacted at a particular price. This means 10 buyers or shares from one side were sold and 10 from the other side were bought, summing up to that volume of 10. Now, let's delve into what we can deduce from volume. It allows us to discern whether the buying side is displaying more aggression than the selling side. This is a crucial aspect that many traders tend to overlook. To decipher the strength of each side, we employ something known as auction market theory. Picture the market as a vast auction place where buyers and sellers strive to find an equilibrium in price with each transaction. In this auction scenario, you've likely encountered the terms bid and ask before. The mechanics involve individuals and institutions placing orders, either as market orders or limit orders. This activity is visible on level 2, where bids and asks are displayed and executions unfold in real time on the time and sales board. If someone executes a market order to sell, they are being aggressive on either the buy or sell side, depending on the market order's direction. On the other hand, if they place a limit order, you'll observe it on either the bid or the ask. Consider a financial instrument that is ascending, and simultaneously, its volume is increasing. This suggests a supportive interest at those buying levels or the new levels the market is reaching. Conversely, if the instrument's price is rising, but the volume remains stagnant or decreases, it indicates a lack of interest at those levels. Continuous growth in volume signals sustained interest at those particular levels. This fundamental understanding of volume is pivotal, placing it alongside price action in terms of importance. As I mentioned earlier, there's more depth to volume, encompassing order flow and the nuances of auction market theory that govern market dynamics. However, before we delve deeper into these intricacies, let's shift our focus to the second component: understanding price action. For me, price action has always been the guiding force. It's the king of my trading strategy. I prefer to scrutinize what the price is conveying to me, paying attention to the market's dynamics and the accepted price levels. What direction is the market taking? Once again, I underscore the synergy of combining price action with volume, forming a comprehensive approach to market analysis. Now let's explore the various components within price action that you can analyze. It involves delving into candlesticks, examining supply and demand, and identifying support and resistance. The goal is to piece together these elements, aiming to comprehend the areas of strength and determine where the market feels comfortable trading. Essentially, it's about understanding the zones where the market accepts a particular price. When the market perceives the current share, stock, forex, or any other price as fair value, it tends to trade around those levels. However, there are instances when this fair price can shift due to economic news, Federal Reserve announcements, earnings reports, or other influential events. These occurrences introduce imbalances and spur aggressive buying or selling. At times, aggressive buyers may step in, propelling the price higher. Observing these developments on charts allows us to visualize and interpret the market's signals. It helps us discern whether the market is genuinely strong, trending, experiencing a robust breakout or breakdown, or if there's merely a temporary trap. Now let's touch upon an indicator, RSI. Some might suggest buying or selling based on RSI readings above 70 or below 30. However, it's crucial to understand that RSI, like many indicators, is a lagging indicator. It follows the price movement, meaning it reacts after price changes. In contrast, price action and transaction volume are ahead of the game. They provide real-time insights into market dynamics. If your chart is cluttered with numerous indicators, it's advisable to simplify your approach, strip away the noise, and place a substantial focus on price action and volume. Utilize these two pillars to construct your trading strategies and playbooks. They offer a robust understanding of markets, revealing where imbalances in price and strengths occur. This approach allows you to comprehend market dynamics on a profound level, steering clear of unnecessary data cluttering your charts. Remember, simplicity, coupled with a deep focus on price action and volume, can be the cornerstone of effective trading. If you're an advanced trader with years of experience, well-versed in price action and volume intricacies, I'll be delving deeper into an upcoming video specifically focusing on order flow. What I'm discussing now is merely scratching the surface. There are layers beneath that offer a profound understanding of market dynamics. We'll explore how to truly decipher strength and imbalances, identify real supply, traps, liquidity challenges, and more in subsequent videos. For those not yet exposed to these concepts, take a step back. Simplify your approach to trading. Avoid overcomplicating things by searching for obscure indicators or drawing an excessive number of lines on your charts. Instead, concentrate on understanding volume and price action, blending them seamlessly. In the weeks to come, we'll build upon these fundamentals, progressing into deeper layers. Now, I'd love to hear from you. Share in the comments what tools and indicators you use in your trading and what has proven effective for you. Perhaps there's an indicator I haven't encountered yet, and your insights could be invaluable. If you found value in this video, give it a thumbs up and follow for more content. Thank you, and I look forward to seeing you in the next video.